Okay, let's jump right in. Right now, we're seeing something that, on the surface, just doesn't make a whole lot of sense. The stock market is hitting record highs, which is great, right? That means optimism. But at the exact same time, gold is also hitting record highs. And that usually means fear. So what is actually going on here? Let's dig in.
And that brings us to the big question we're tackling today. If gold is actually outperforming stocks, what does that really signal for your money, for your investments, and for the entire economy? Because this isn't just some quirky trend to watch, it might just be a massive warning sign.
I mean, just look at these numbers. Over the last 5 years, the S&P 500 is up an impressive 88%. But gold? Gold has absolutely soared 180%. Now let that sink in for a second. Even as stocks have been climbing, their real value, when you measure it in something solid like gold, has been falling way behind.
So let's get into our first section, a tale of two highs. It's like we're watching a clash between two completely different stories about the economy. On one side, you've got stocks, representing growth, innovation, and a bright future. On the other, you've got gold, which stands for safety, caution, and a hedge against things going wrong. And both are screaming from the rooftops. We need to figure out why.
And this gets us to the absolute heart of the matter. We measure everything, especially the stock market, in US dollars. But what if that measuring stick itself is broken? What if the dollar is shrinking and it's just creating an illusion, making our gains look way bigger than they actually are?
To really see this in action, we can look at something called the S&P 500 to gold ratio. Now just think of it this way. How many ounces of gold would it take to buy the stock market? Well, back in the year 2000, right at the peak of the dot-com bubble, it took 45 ounces of gold to buy one share of the S&P 500. Stocks were wildly expensive compared to gold.
Okay, now let's fast forward to today. To buy that exact same share of the S&P 500, it only costs 1.4 ounces of gold. That is a huge shift. So when you stop measuring the stock market in dollars and start measuring it in gold, you realize it hasn't gotten more expensive. It's actually gotten way, way cheaper. The whole game has been turned on its head.
So you have to ask, right, what on earth caused this? Well, that brings us right to our next section, where we're going to look at the cause of the problem, our so-called broken measuring stick, the US dollar.
It really all boils down to two different mindsets. When you buy stocks, you're buying a piece of a company. You're betting on something, on innovation, on future profits, on growth. But when you buy gold, you're not betting on it to invent the next iPhone. You're betting against something. You're buying it as an insurance policy against the US dollar losing its value. One is optimism, the other is protection.
And this gets to the heart of why some big money investors are getting so nervous. The US dollar is what's known as a fiat currency, and that's a really important term. It basically means our money isn't backed by anything physical, like a vault full of gold. Its value is based purely on faith, on trust in the government that issues it. And when that trust starts to wobble, well, so does the dollar's value.
The moment everything changed was August 15, 1971. That was the day President Nixon officially cut the US dollar's tie to gold. That single decision basically untethered our currency from anything real and gave the central bank the power to create more money, essentially out of thin air, with just the push of a button.
And here's where it gets really interesting. This pattern we're seeing today, it is not new. In fact, history shows us that when gold starts to outperform stocks this dramatically, it's often a canary in the coal mine for the whole economy.
Just take a look at this timeline. Over the last 100 years, gold has really only crushed stocks a few times. The 1930s, during the Great Depression. The 1970s, during stagflation. Then you have the dot-com crash in 2000, the financial crisis in 2008, and the pandemic in 2020. Every single time, it lined up with a major economic crisis. And that brings us to today, with that big question mark hanging over everything.
So if this is a major warning flare, who's actually paying attention? I mean, who is driving this massive surge in gold prices? Turns out, it's some of the biggest and smartest players in the world.
So let's get specific. Who's behind this incredible demand? This isn't just your average retail investor buying a few gold coins. We are talking about the heavy hitters, the kind of players whose actions tell you a whole lot more than their words.
It really comes down to three main groups. First up, central banks. Countries like China, Poland, and Turkey are buying up physical gold by the ton to get away from holding so many US dollars. Second, you have sovereign wealth funds. Think of them as giant national piggy banks for entire countries.
And third, you've got influential billionaires, guys like Ray Dalio, the smart money, who are sounding the alarm about major economic shifts.
Okay, so this all brings us to the big so what? What does this all actually mean for you? In our final section, we're going to talk about the real golden rule for navigating all this. And spoiler alert, it's not about just blindly chasing what's hot. It's about understanding what's really happening underneath.
But first, a really important word of caution. Let's be clear, gold is not a one-way street. After the 2008 crisis, gold went on an incredible run. But then, around 2012, when all the fear about the economy collapsing started to fade, gold prices crashed, and they stayed down for years. It's a powerful reminder that gold runs on fear, and when that fear disappears, so can its high price.
And this quote right here just nails it. You can print as many dollars as you want, but you can't just print more wealth. We are living through the consequences of that idea. Central banks can create trillions of dollars, but that doesn't create new houses, new factories, or new ideas. It just makes the money that's already in your pocket worth a little bit less.
So what's the actual takeaway here? It's all about real diversification. And I don't just mean owning some tech stocks, some bank stocks, and some industrial stocks. That's like diversifying your dessert by having different flavors of ice cream. It's all still ice cream. Real diversification means owning completely different types of assets.
So this is kind of what it could look like in practice. A truly diversified portfolio might have stocks, sure, but also hard assets like real estate, a bit of gold as that insurance policy, and maybe some other alternatives too. The whole point is to own things that don't all move in the same direction at the same time. That way you're ready for whatever the economy throws at you.
And this really brings us full circle, leaving us with a huge question. When the very thing we use to measure value can be created out of thin air, it forces us all to step back and ask something much more fundamental. In a world of printed money, what is true wealth? And that really is what this whole story is all about.